What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Hey there, my 9-year-old daughter has a reminder for you using this paper katana, and that is to make sure you hit the gear and use the speed controls, because it changes it from this, ready, into this. Like magic. I'm joined today with Vanessa Delgado. How you doing today, Vanessa?
I'm great. How are you, Dan?
I'm fantastic, and I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's obviously because this is a chance encounter where I interview commercial real estate players. That means it's buyers, sellers, deal sponsors, passive investors, operators, all that kind of stuff. And you might ask yourself, why are you doing that? And the answer is, if you've ever heard of private off-market deals, these are ones that you often are not allowed to publicly discuss. You should know that securities attorneys and the SEC want you to have documentation of your prior substantive relationship, or else the SEC might get ants in their pants and take away your business in the form of rescission, which is bad. So I have people on here and we talk about what are your core competencies that you contribute to your deals, what's your buy box, and all kinds of fun stuff like that. And the benefit to you is you'll learn how to more effectively communicate on the subject of commercial real estate deals. But before we get too into the weeds, Vanessa, do you want to introduce yourself a little bit for the audience?
Sure. So as Dan mentioned, I'm Vanessa Delgado. I am brand new to the commercial real estate space, but it really stood out to me as a way to really be able to maximize your gains as opposed to, say, single family or other kinds of real estate. And so I decided to get into it after having worked for in the biotech industry for the last 16 years, starting off as really an entry level, analyst right out of college, working my way up to management and really seeing a lot of parallels between like multifamily and biotech, especially in the space where it's not just getting into the deal, but really closing the deal. And so I like seeing that you can establish various systems in place to make sure that the business is successful, just as you would say office space.
I love that answer. So the first segment that we always go through is the 5 distinct motivations for being involved in a commercial acquisitions. Before I do that, I gotta say, but wait, check your rate. So Vanessa, it's clear that you have some sort of technical acumen, and I'm wondering, can you try to look through your camera and into the user's device? Because down there might be this big ugly subscribe button that they really should do something about. Okay, it's a stupid YouTube joke, but what can you say? What can you say? I've been doing it for so long. Anyway, the 5 distinct motivations. Now, I've now literally interviewed hundreds of different commercial real estate players, and everybody has their own unique reason why they are getting involved or continue to stay involved in these commercial acquisitions. Now, even though each of those reasons are unique, I find they fit pretty neatly into these 5 different categories. And the reason why it's important to know what that motivation is so you know when the going gets tough, are they just going to throw in the towel, or what's going to keep people sticking around? Now, the first distinct motivation I found, some people, they already have a portfolio of assets. Maybe they're work optional, or maybe they are just high income earners and they are every year putting a certain amount of their income into different investments. And when I say preservation of purchasing power, what I really mean is that if inflation rears its ugly head, it's going to be necessary to make another acquisition because it's going to eat away from the value of your cash flow. But the main thing that distinguishes people who are preserving their purchasing power of their savings or investments, it's that they're not going to be making deals every 10 seconds the way that some people who are more motivated by transaction fees and things like that, they're going to be inclined to be doing more deals more often. And the real key as far as the strategy goes is when you're preserving your purchasing power, you're going to have to negotiate the steepest discount you possibly can, which is what people should really be trying to do, or they're going to be jumping in when there are an asset crash, basically heavier amounts of distress than normal, and that's what they're up to. And full disclosure, that's not where I am in my real estate journey so far. What I'm up to is trading time directly for wealth instead of seeking a bigger and better salary. I've got a tech background myself, specifically in the CRM space, basically building online funnels for different businesses, and all roads lead to real estate when you are getting bigger and better clients. And so starting in 2014, I basically was winding down that CRM funnel business and started working for a guy who was already doing 10 different single family transactions per month for years before he hired me to take care of all of his online funnels and pages and promotions and all that kind of fun stuff. But very quickly I realized that as you get a bigger and better salary, getting up to CTO or that C-suite or whatever it is, you have a much bigger tax bill that comes along with it. So I figured out, hey, I must be on the wrong side of the right business. So I ended up making my jump into real estate to be compensated in the form of deployed capital, aka equity, and get the different advantages of that. Now, I get that that's subtle for some people, especially youngsters. Usually, youngsters are more interested in hustling like crazy right now so that they can retire early. But other people, they are working professionals, and more what they're up to is they just want to control their schedule a little bit more. And that is absolutely fantastic. I think people really should spend more time with their family than they often do. And so that's why I think it's important to have that sort of balance, and real estate, that's one of the checks that it actually writes that it can follow through with, is having more freedom of time. But the pitfall of a lot of people who have this attitude of wanting to retire early is they think that everybody secretly is trying to retire to a beach at the youngest age possible. And I assure you that's simply not true. Some people,
Right.
for example, people who are fueled more by ambition, they're after that legacy generational wealth. They want to make sure that their great grandchildren never have to hold a day job, and that's why they're going to be hustling into their 90s. And now, of course, I get the fact that in some circles, that level of ambition is somewhat vilified, but you have to remember you can't be asleep at the wheel when it comes to running a property. Somebody needs to
Right.
be motivated to come in and day out and make sure that the things are running smoothly. It's a nice place to live or rent and run your business. We're talking about commercial real estate here. And so you need to have some people on your GP team who have that level of motivation. Now, of course, they're not the only ones who are going to be hustling into their 90s. Some people have picked a sector of society, or maybe it's animals, maybe it's the environment. Who knows? But they found out that there's some sort of big difference they want to make in the world, and there's a financial component to making that work. So that is why they are making their commercial acquisitions. So, Vanessa, of those five different motivations, what combination of them stood out and do you feel describes you best?
That is a great question. I've had to ask myself that time and time again, and even use it partway in my journey because I know it's not going to be, a smooth ride all the way. Um, I've even seen hiccups along the way now, and there is definitely that question of, can I do this? That eats at you, especially just being so new into it. And for me, what my whys are really to support my family who essentially needs it. I currently just bought a home, and my elderly aunt, she's 78. She's still a chili pepper. So she's, she's still full of life, but she lives with me and I support her. So I want to make sure that when she actually decides to not want to work anymore, that she's okay. I also have some nieces and nephews. I don't have any children of my own, but they're in school age and I want them to grow up actually being financially literate. I come from immigrant parents who didn't know about investing. They're starting to know now, thankfully, because of me. But I want to teach my nieces and nephews early and give them kind of a real start in life because even though I went to college, I didn't go to my choice college because, I couldn't afford it. So I want to give them a chance to do so and be able to get into the grades, the schools that their grades can earn them, and really kind of know early on, what investing is, the benefits of doing so, whether it be in real estate. Of course, I'm going to leave them something, but as well as understanding, all the different investment vehicles that they can utilize with real estate being, the primary one. So that's really what my mission is, for me. But long term, I really want other people to, learn to invest as well because it's not inaccessible. It's better to essentially, buy assets and then utilize those assets to pay for, your luxuries. And so it's really my mission. Obviously you want to take care of home, but teach others to do it as well and just teach others that it's really possible.
I love that answer. Now, of course, one of the pitfalls of discussing motivations like that is that you run the risk of seeming too optimistic and acting like there aren't risks involved. Of course, Vanessa did a great job of mentioning that and making sure to keep grounded in these sorts of things. But if you've ever been involved in one of these off-market deals, one of these 506B deals, the private ones that you're not supposed to publicly discuss, the securities attorneys that are involved in the offer, they would have insisted that everybody fills out this financial questionnaire. Sometimes they call it a suitability questionnaire. It has asks all sorts of financial questions as far as your investment experience, your net worth, your income, all of that kind of stuff. It's not that comfortable to fill out, but it's the law basically. And one thing that jumped out to me when I first filled out one of those questionnaires was when I got to the tolerance for risk assessment question, I found that it lacked utility. It didn't matter which of the multiple choice options you chose. It didn't really give me a real firm indicator of your perception of risk. So for these interviews, I made my own, which is a fill in the blanks question. It is. There are many popular investment asset classes, but I think blank is too risky. So Vanessa, it can be inside real estate, it can be outside real estate, you can have one of each if you want, but what's too risky for you to invest in?
I would say that outside real estate is too risky.
Mm-hmm, mm-hmm, mm-hmm. So like you're talking like stocks, you're talking like that, like those types of things, or
Yeah, honestly, because there's this interesting sort of line. For example, people are doing things like arbitrage, Airbnb, and things like that. I find that to be incredibly risky. For example, I actually looked into it myself, but then as I dove further into it, I realized that there are a lot of laws and statutes that limit the ability to say sublet and apartment, and then especially depending on where you are in that market, you're subject to the seasonality, of the whatever the high season. Um,
Mhm,
and so that was something that just said no. And I know a lot of people, especially younger folks who want to find that entry into investing into real estate or looking into like Airbnb arbitrage.
mhm,
Um, I would say that looks very glamorous, but with the high potential for the reward, it is really high risk.
mhm,
Especially you're going to be responsible for paying, on that rent, regardless of whether it's, whether there's someone in there or not. And on top of it, you're also required to, put up the startup costs on, furnishing the apartment, regardless of whether it sits empty. So that's kind of really what pushed me into real estate, multifamily, just knowing that, economy of scale really means that you do see earnings regardless of whether you have a unit that's vacant or not.
I love that answer because, yeah, like with Airbnbs, your cost per door is so much higher. There's so much that's out of your control. Like, if somebody gives you a two-star rating or something like that, your listing is basically cooked. It's really, really bad news, all those different things. And then there's the fact that you get in the crosshairs of municipalities and they might just completely shut you down, especially in major MSAs. It's at the end of the day, I think Airbnbs, it's not innovative. It's a hotel which has been around forever, and so you have these different franchise hotel companies that are they have a really good vested interest in shutting those down. So it just
Right.
I definitely am there with you. Now, as far as the next segment goes, I gotta confess, for the first couple hundred of these chance encounters, I didn't include this because I thought that if you're new to the industry, this is a little bit fastball. But at the end of the day, everybody is a curator of deals. You have to choose different deals. You have to know at least, like two or three different metrics to first do some sort of underwriting and be able to distinguish one deal from another. And so I have to jog people's memory. I've got 14 different metrics that are frequently spotted as the ones that people hone in on. And for anybody in the audience who's listening and not watching, I'll read those out and explain them to you so you've got some sort of idea and you'll understand what my guest tends to zoom in on. Now, the first one is cash on cash. Second one is IRR, which is internal rate of return, also known as an equity multiple. The idea being that if you invest 100K or something like that, what's the multiple of the 100K you're projecting that you're going to get back after the investment? And that's the one that I tend to focus on my own portfolio personally. The next one is the cost per door. We mentioned that in the sense of an Airbnb, you have to have an entire house, whereas if you're getting in an apartment building, the cost per door is going to be much lower. Then there's the net operating income of the property. There's the going in cap rate, and that's basically a back of the envelope way to find out what sort of discount you're getting, because major commercial brokerages will publish what the typical cap rate is for a particular area of a particular city. So you can basically see, like, are you getting the money for cheap, the cash flow for cheaper or not, just by comparing cap rates to what's going on in that area. Next one, there's the loan interest rate, which is of course especially important if you're assuming a loan. Of course, that's changing a little bit recently with some different interest rate cuts, but whatever. The next one here is occupancy rate, which is the inverse of vacancy. So if you hear vacancy or occupancy, just realize that they're just the inverse of each other. Then there is the average income where the property is located, so you get an idea of how much disposable income a typical earner has. Then there's the amortization period of the loan, especially important if you're going to be assuming it. Then there's the market versus in-place rents. In other words, how much are people, say, underpaying in their rents right now, or is it basically right at the limit? Is there some upside you can find just from raising rents? Then there is the population growth where the property is located to give you an idea of what sort of appreciation from just demand is likely to occur, because basically more people are moving in, they need more, and they will be willing to pay more in rent as that goes. Next up, you have the sponsor record, which is how many deals are on the go right now, how many deals have already gone full cycle. Then there's the waterfall, split, or exit strategy, which is basically talking about what's going to happen to your investment after it's gone full cycle, or is the intention to, buy and refinance and just basically hold it for a more extended period of time, or is it supposed to be all done with in like 3 years or something like that? Then the last one I have on the list is DSCR, which stands with debt service coverage ratio, which is about how much of the revenue is going out the door immediately just to pay for the loan. So again, this isn't a comprehensive list. So Vanessa, you're welcome to add another if you depend on it. But do you want to give like a top three or something that you tend to focus on?
Sure, absolutely. So, having been in biotech and being in data analytics, I've just learned to rely on the numbers the most. So, really in my journey, not only is it important to, kind of understand the business side of things, it's really understanding how to get into the deal. So, I do do a lot of underwriting, and so I do have to look at these metrics to see what makes sense to me. And the first thing that comes to mind is after I underwrite a property, I really do look at the IRR, the internal rate of return. That is the equity multiple, which tells me, at the end of the deal, how much are my investors making back on their investment. And I've seen some really amazing deals where, with a standard investment, they are seeing double the return on the investment after the 5 years. That is with, the cash flow. That is the, I guess you could say the cash on cash. I'll go into that a little bit more, but that as well as the appreciation, that is, the waterfall split or the exit. So in a way, I guess you could say those already have defined like the top three that are really important to me and what would matter to my investors, and making sure that they find that their investments are worth their money and their time. Because being brand new to it, I want to make sure that I have a long career ahead of me, and I want to make sure that they're happy with it. But one other thing that matters to me specifically, maybe not so much to my investors, at least directly, is the sponsor record. Are they able to go full cycle? There are a lot of stories where people say, people or sponsors will go to the bank on the loan for you, and that's all they do. And they're basically a guarantor, and they leave you to it. And that's not good news for a new partner like me, because I don't want to get in trouble with the bank, my investors, or just in the industry, and just to protect everybody involved. So I think that's really, really important to consider as well.
I'm just eating up that answer like a delicious subscribe sandwich. I'm big on subtlety. I don't know if you picked that up, but that reminds me, it's time to bring out the Dan Does Deals Commercial Court Competency Cube with the 6 different roles in a commercial real estate deal. Now, I go through each side so that you are going to learn how to more effectively communicate on the subject of commercial real estate deals and better understand how my guest fits into those deals. And as I'm doing that, if you're sitting there thinking, hey, I really need to get me one of those cubes, the great news is it's absolutely free. You just go to dandoesdeals.com. There's this big conspicuous button. You click on it, goes straight to the PDF. You can print it out, make it like craft time, like you're in primary school again, something like that, and you can show it to your friends and family, because really being able to effectively explain, people tend to say this person's a commercial investor, this person's a commercial investor, that person's a commercial investor. What do they do? That tends to be a bit of a challenge, which is why I ended up making this cube. Now, more likely than not, if you are meeting a commercial real estate investor, you're probably talking to a repositioner, because they are the deal finders. They're the ones who are figuring out how are they going to find more upside. They are the curators of deals. They're doing all sorts of paperwork because they're looking at all sorts of different deals. They need to find out, hey, is this property even making the amount of money that this seller slash broker is claiming it is? Because there are plenty of ways you can have some fun and games with the numbers and basically misrepresent the truth. So the repositioner needs to look through that. Now, if I were to say the most peculiar part of being a repositioner, it is because they have to rub elbows with all sorts of financiers. So financiers, it's a few different people, but the thing they all have in common is they deal with capital, paperwork, and the owners. They do not interact with residents or tenants or whatever you want to call them, the people who are renting. They are not part of the responsibility of financiers, and repositioners have to have big financier or investor relations as part of their business, because First of all, this is a very capital intensive business. You like when you pick up one of these properties, it's going to be big numbers that you're talking about. And if you can secure either a more advantageous loan or just cheaper money in general, that's going to go straight to the profitability of the building. Okay, so that is why repositioners spend so much time meeting all these different financiers. Now, the next more intuitive spot that a repositioner is going to look to try and find upside is they're going to get an operations team involved or take a look at what the operations team is doing to see why are these Benjamins going down the toilet. Now, of course, there's a lot more to operations than just collecting rents and mowing lawns and all that sort of fun stuff. There's also the part that I throw my hat in the ring when I'm on a GP team, which is the digital side of things. Now, of course, sometimes you need some sort of inventory or web-based application for the residents for this, that, or the other thing, maybe some sites and all that kind of stuff. But if you understand that the real deal killer is vacancy, in other words, empty units are what make people lose money in this business, then even if you're focusing on bigger properties like I tend to, 100 units or more, the fact is if those units aren't filled, somebody on the GP team has to have some serious marketing chops to get those units filled, and so that's where I step in. So that's how I get involved in as a GP on these different deals. But there's only so much efficiency you can find in operations. So frequently the next thing a repositioner will do, they'll get a contractor team involved to renovate the place, make it nicer so that the current and future residents are happy to pay more in rent than they previously did because the place is nicer. But if only things were that simple, you can spend endless amounts of money on renovations and it's not necessarily excuse me, going to translate into an increase in the return on investment, like if you're gold plating toilets, for example. Now, of course, the other ways that you can run into trouble with contractors is maybe they'll use subpar materials. I have a friend who found drywall under roofing, which is insane in an apartment building. That was a pretty recent scare. But there's also the time factor, which is, like, are they dragging their heels? Are they basically doing one-off day trips to some other renovation site, or are they sticking to it and getting done? Because, like, at the end of the day, you're borrowing money to buy this property, so time is quite costly. So to make sure that the contractors are doing the job that they really ought to, if you're like me, I don't know if you know this about me or not, but I'm from the internet. So that means I need locals. I need boots on the ground to keep an eye on the contractors, to keep an eye on the third-party operations, the property managers. Somebody needs to be able to be there in an hour or two. And categorically, that won't be me. I'd still be stuck at an airport in an hour or two. So somebody needs to be able to be there who's really got the back of the owners and investors, and there are different conflicts of interest that the operations team and the contractors will typically have that go against it. So that's the role of the local. Now, Vanessa was kind enough to already allude to the sixth and final role on the cube, but to explain it fully, I like to use a hypothetical. Maybe you already have some single family rentals, maybe you have some Airbnb short-term rentals, something like that. So you get the idea already that you have to drum up a deposit and then you borrow the rest. So maybe you're a physician or an engineer or an attorney or something like that, and you're thinking, hey, I want to get a piece of that 350 unit apartment complex that's down the street, and I know how this works. I can just turn around to my friends at work and say, hey, let's all throw in 100K and then we'll take over that great big building. So full of confidence, you turn around to the banks, the lenders, and you say, I want to buy that building that's worth tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Now, of course, that should give you a little bit of pause, because the lender is going to ask you a question where if you're in a mentorship program or you have a guru or something like that, they might gloss over this. So I encourage you to listen very carefully. They're going to ask you, who's your KP? Who's your deal sponsor? What's that all about? Now, these different lenders, they're ultimately in the business of not losing money. So they have to make sure that they don't lend it out. They don't consider anybody eligible unless it's a pretty safe bet. So one of the things they're going to require is that if you want to buy a 350 unit apartment complex, somebody on the GP team needs to already own a 350 unit apartment complex. That way they know they're not going to lend you the money and you're just going to lose it all, and everybody's behind the eight ball. So that is what a sponsor is. Now, on top of having the sponsor at KP, having somebody on the team who has that sort of experience, you're going to need a certain amount of liquidity to prove you can effectively run the business. And then there's the collateral for the loan, in other words, a balance sheet among the GP team of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Vanessa, you mentioned being a little bit newer, so I'm sure that the repositioner part explains part of what you're going to be up to. I'm not sure if you're going to be local in your backyard, but obviously there's going to be some of the operations as far as asset management that you're going to be doing, and then of course financier relations is something everybody has to do. So do I have that right, or where do you figure you're going to fit into your next deal?
Absolutely. So I've learned from other professionals already established in the real estate space that you have to play a little bit of everything in a way where you do have to essentially look at repositioning, financier, or operations. And you're definitely going to have to play operations because the SEC makes you. So I want to leverage, all of my experience to do that. And where I will be the strongest, of course, is in repositioning and operations, and knowing that as I speak about my business, speak about real estate, that I will be talking to potential investors as well. So there is that financier portion of it, and it is my responsibility to cultivate those relationships. Really, I think all three are important, but what I typically focus on, because of my 16 years looking at numbers, I do like the repositioning part of it, because I do think that the key to getting into any deal is making sure that you have solid and conservative underwriting. You've done the due diligence of research. And, particularly for me in biotech, I am in research. And so, that's kind of like my shtick, where it is important to know about the property, know about the market, know about the job growth, know about the population growth, know whether the area is experiencing any inflation, that is, the costs of the buildings are going up. I don't want to throw out fancy words there like cap rate, compression or anything, because a lot of people don't know what that is, but it's really just inflation that's driving up the costs of buildings, where you're not really getting a fair value on the property. And I don't want to put investors in that situation.
I love it. I love it. So that brings us straight into the buy box. So when investors or repositioners, basically anybody in this space, is asking somebody, hey, what's your ideal property? We're really asking about three main things. First one's geography. Where is it? Which states, which counties, possibly even which neighborhood. It's absolutely going to matter. The second one is size. Now, if you're talking about multifamily, the way that they talk about size is usually by the number of apartment units, which is called a unit count. The reason why it's relevant is because the type of company that's going to take over 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 100, 150, 250 unit apartment complexes. So you're going to need to know about size. Now, of course, there are other types of commercial real estate, such as industrial or warehousing and retail, and those won't go by unit count so often as square footage or even acreage, but that size constraint still applies. Now, the third one is usually called class, and I don't like the term class because it makes it sound like it's one thing when there's actually two parts to class. I like to separate them into being called desirability in general, but the condition of the property and the area that the property is located in. If you're talking about condition, we're talking about how recently was it built, how beat up is it, how recently renovated was it, and what sort of luxuries and amenities are included for anybody who rents there. That's the condition. condition. Whereas if you're talking about the area, the first thing is the old broker trope. They say location, 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 when I call it a trope because they really mean traffic, traffic, traffic. Is it busy or is it basically crickets all day long? If you've got more people passing by a property all the time, it's going to have more baked in desirability, so the value is going to be higher. Now, of course, since we're talking about residential, the crime rate is going to matter regardless of the type of real estate. But one of the special parts about residential real estate, like apartment complexes, is the school districts are also going to be quite relevant. But both the area and the condition are ranked the same way as in grade school. So you have A plus at the top, and then you have A, and then A minus, then B plus, and so on. So Vanessa, as far as you and your buy box, like I understand that maybe it'll be changing since you're new, but as far as coloring in the lines there, what you looking for these days? What do you expect to be focusing on?
Sure. I am looking in Tennessee, where I'm underwriting properties sort of in the Nashville area down to Middle Tennessee. And so I like that area because you do see that it is a location that's landlord friendly. You do see that it's also business friendly. You have Nissan down there, Oracle is moving down there. You have, the Nashville airport, you have Vanderbilt University. So there's a lot of diversity, economic diversity down there. And so you can support both, national and local economy. And what else I also like is that it is a central location. It is about an 8-hour drive to most of the states in the lower 48, and so it's very easy to get materials to the apartments, to bring materials out. There's just a lot of infrastructure there. Also, what I see about Nashville in particular is that you do see some growth in the next 4 years in terms of market rent. And so to me, that's like a perfect mixing of, population growth because of the business growth, and you see rent growth. So that's one of the reasons that I really like underwriting in those areas. Um, and so what I'm particularly underwriting are units that are 30 units to about 120 units. I want to stay kind of in that mid-size range, especially as a newer operator, because I am well aware of the raise that I would need to be capable in order to close these sort of deals. And so within those units, I'm also looking at you could say mid-rise, so about 3 stories, garden style, ones with pitched roofs. I do like the garden style because you can utilize a property to build more on it. Um, and the particular property class that I'm looking at is, I guess you could say, well, the asset class or the or value adds. So where I can, write in various uh, exterior and interior abilities to reposition and drive up the appreciation value at the end. So that's really what's in my buy box. What I do tend to look at as well are there local schools nearby? How central is it? Especially being in Nashville, you do kind of want to look at the walkability to, the downtown area, especially with it being so spread out. And of course, crime rate is important as well. So these are the things that I consider when underwriting a property. It's not just the numbers. Once you do that and you find what's in your buy box, like, does this work? Then you go out to the neighborhoods, you go out to um, eh, the overall economy and see if it's worth it.
That makes lots of sense. So, of course, the next part here is really about people. When you're newer to real estate, of course, the financiers, more investors, you're always going to be eager to speak to. Basically, everybody's going to be sourcing capital. And then, of course, the sponsors and KPs, you're going to have to know oodles of them, more people who are already got that foundation. And, of course, myself, those are what I tend to focus on, especially because with my marketing and digital background, I can basically be more beneficial to somebody who already has that foundation in place, as opposed to a typical repositioner who needs grunts who are putting in 80 to 120 hours per week. I'm not at my most efficient. I'm not at my highest amount of benefit in that sort of environment. So that's who I'm looking for. Does that match you as well, Vanessa? It's the KPs and financiers you most want to reach out, or am I speaking out of class and you need more operators, or who are you looking for out in the audience?
Essentially, yes. Looking for sponsors as well as financiers, who can help raise capital on deals that I'm underwriting. And uh, yeah, I think that is really important to understand, how we work together, what the synergy looks like, because if I'm out, busy writing deals and also raising capital myself, and you meet partners who, yeah, I want to get on your team, I want to know who you are, but they don't take the time to also do the market research. They're not taking the time to reach out to sponsors, or they're not taking time to, kind of get out of their comfort zone and put in the same work. Then it doesn't really work out.
Excellent, excellent. So then it comes to how to reach out, and I'm going to sandbag that, talk about myself for a second. I'm fortunate enough to have this really distinct last name. Sure, it's hard to spell, but at least when you search for me, you're definitely got the right guy. And LinkedIn is the social media platform where I spend most of my time. So if you want to appear on this show or on the show that I confess it has better viewership, chesswithinvestors.com. If you want to appear on that show and talk about your investments in that format, I'm really excited to have more guests. Of course, you can find more episodes of these Chance Encounters on dandoesdeals.com. As far as this QR code, if you scan that goes to my author page on amazon.com, where I've got a few different books on different business skill building related topics. But Vanessa, you've got a QR code up there. You've got your website, your email, and your phone number on there. Those are the best ways to reach out.
Yes, they are. And I do respond to messages very quickly.
Excellent, excellent, good stuff. So that only leaves one more thing. It's the public service announcement. So it's not for you, Vanessa. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button that maybe you didn't get around to hitting yet. And full disclosure, I want a gazillion people to hit the button so those deadbeats at YouTube start to pay for these videos instead of me. I think that would be amazing, right? The trade-off to you, it costs you absolutely nothing. All it means is my videos may show up on your list of suggestions. You can feel free to ignore those suggestions. Frankly, I just appreciate the fact that you spent this time with me. Just like Vanessa, I appreciate you joining me. This has been fantastic.
Yes, thank you for having me on your show. This has been a pleasure.
Awesome. Thanks.
You want to underwrite something, and there are people charging anywhere from $5,000 to $5,000 to underwrite something for you, and I just don't see that that's fair. I think our goal is to demystify, or however you want to put it, the underwriting process. Is it smoke and mirrors? Is it that simple? In most cases it is, but I think people are just making it way too complicated, and my offer is, you bring something to me, we'll underwrite it, no fee. Maybe we'll get some views, maybe you'll find people who are interested in what you're looking at and take it from there. I think our goal is to show people that they can do it themselves, to show them that it's pretty straightforward and easy to do. Some people like to be more conservative, some people like to be a little more free-spirited is kind of the way to put it. To go out there and make some money, you're risking money, and that's kind of the goal here. The goal here is to kind of give you the basics so you can go into that next phase. The whole goal would be to create a spreadsheet basically of what your risk tolerance is. and find something that fits your mold. Instead of underwriting 100 deals, find the deals that make sense to you. Do you want cash flow? Do you want appreciation? Do you want equity? That's all stuff that we'll go through. And I think it'll provide an immense amount of value for people to look at their next possible investment. We made sure that, what you're looking at is viable and profitable, because those are the two major factors when you get into this. When it's brick and mortar and you have assets, it leads you down one path. When you're looking at a strictly online business that may have intellectual property or something to that effect, you have to kind of look in that direction as well. So each bucket is going to have its own little nuances. No catch, just knowledge. I think you're going to get a lot of value from this, and just to show you that it's not something you have to pay for. There's no point in wasting time, money, and energy into something that's not going to be fruitful. When you look at these billion-dollar deals that I've looked at versus the $100,000 deals that I work with, the only difference is capital. There's really not much different to it. I mean, there might be more points on this end, or there might be, some hidden asset on this end, but it doesn't make a difference. It all comes down to capital and how you can make money. We're going to have a lot of fun, and we're going to get into the numbers. We're going to look at why this business is profitable and what we plan on doing. There's no reason to beat around the bush. There's no reason to mail it out, wait 2 weeks for a bad example. We're going to go through it pretty easy, 10, 15 minutes, and you're going to get an answer. You're not going to have to wait. You're not going to have to look deep inside anything. The truth is, it's basic. Bring a franchise, bring a friend, bring a building. I mean, we can underwrite a horse race if you want. We can underwrite just about anything to make sure that there's value in it. We can figure out the Pokemon and Jordans, but a lot of that's just going to kind of be researching eBay.
And what sort of businesses can we underwrite in these sessions?
Bring anything. I mean, we can underwrite a garbage company. We can underwrite. Do it again.
Sure. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.